Let's go to recording. So this is chapter 12, relevant cost for decision making. Now we're going to start making decisions today. In order to make a decision, first, and the most important thing is you have to have more than one alternative. Because if you have only one alternative, there's no decision to make. The decision is already made for you. So again, in order to make a decision, you need at least two alternatives. Once we have the two alternatives, what we're gonna compare? First, we're gonna compare the relevant cost, which are different between one alternative and another alternative. Second thing that we're gonna think about is there any avoidable cost, which will be cost that can be eliminated if you choose one alternative versus the other alternative. Now, here we're going to the point, the avoidable cost, the opposite will be unavoidable cost. Which of those is relevant, which of those is not relevant? Avoidable costs are always relevant for our decision. Unavoidable cost, however, is irrelevant. Now, there are two broad categories of the cost that are never, ever relevant. First one is the sunk cost, or something that already happened. Something that you already pay for it. So, for example, if you buy a car and decide to, then you have to make a choice where to go for vacation in Cancun or Hawaii, the cost of the car is irrelevant for your decision. Why? Because it's a sunk cost, it's already happened. Future costs that not differ between alternatives are also irrelevant costs. Which are those costs? For example, what will be example for future costs which is not different between alternatives? And that will be, again, if you decide to go to Cancun or Hawaii, in both options, regardless where you're gonna go, you still have to go to the airport. And since you have one luggage bag for the dresses, one luggage bag for the evening dresses, one luggage bag for the makeup, one luggage bag for the shoes, one luggage bag for the sandals. So you have to take a Uber in both cases. Now the cost of the Uber, it will be exactly the same because it's still in the both cases, both options you have to go to the airport. For that reason, the cost of the Uber will be irrelevant for your decision where to go on vacation, either Cancun, either Hawaii. So, how are we going to proceed with these costs? First, we're going to eliminate the cost and benefit, which are not different between the both alternatives. So we're going to eliminate the irrelevant cost. We're going to eliminate the unavoidable cost. We're going to eliminate the sunk cost, and we'll see what's going to happen. Second, on the remaining costs and benefits, which are different between one alternative and the other, we're going to make a decision. So do we have to make a decision only based on the cost? No. Sometimes we can make decisions against the cost. We can choose the more expensive option because there are other factors that we should be looking for as well. Costs which are relevant for one decision might not be relevant for another decision in another context. So be careful when you're selecting the cost in order to evaluate the alternatives that you have. Let's see with the example here. They give us an example, which is for a person who wants to go and visit her friend in another city. Now she has to travel 230 kilometers in one direction and 230 kilometers the other direction. That's one option, to go with the car and to travel. Actually, she has to travel in both directions. So one option to travel is to choose the car. And the other option is to use a train. Now she tried to decide, based on the cost, which alternative will be the cheapest one. The person prepared some information for us. And the first thing on the list is annual amortization or depreciation of the car. Now the question is this cost relevant for our decision? Can we avoid this cost if we go with the train? In other words, to put it. What do you think? Can I stop depreciation of the car if I decide to go with the train to visit my friend?
I don't think so, because it's calculated annually, right?
And it's also based on historical cost, which we already said the historical cost is a sunk cost. So is the annual depreciation of the car relevant for our decision? No. Let's see the next one. Cost of gasoline. If I decide to go with the train, can I avoid that cost?
Yeah.
Yes.
Yes. So, is it avoidable? Yes, it is. Next one. Annual cost of the auto insurance and license.
That's avoidable. Sorry, that's not avoidable.
What do you think? Can I avoid that cost?
No, because it's future cost.
Is it future or sunk cost?
Sunk cost.
Sunk cost. So what's happened? We already pay for it. Okay, let's put it this way. Imagine you have a car. So you don't have to imagine, you already have a car. And you decide to go to another country for, let's say, 3 weeks vacation. Once you go to the airport, do you think there will be a person from ICBC to ask you, excuse me, where are you going? I'm going on vacation. For how long you going? For 3 weeks. Oh, that means you're not going to use your car, correct? You say, yes, I'm not going to. Okay, then we're going to give you a refund for 3 weeks for not using the car. Do you think that's going to happen?
No.
No.
No. So, can I avoid the insurance if I decide to go with the train?
No, you can't.
No, I can't. Why? Because I already pay for it. The fact that I'm not using the car and the car sitting in my garage and I'm using the train, it doesn't change the cost of the insurance and the license. It's there. Now let's go with the maintenance and repairs. How about the maintenance and repairs? If I drive my car, I have to maintain and repair. If I don't drive it, I don't have to. So is that relevant for my decision? What do you think?
You can avoid it by not
Yes,
going.
if I can avoid it, so that means it's irrelevant. Thank you. Now the next one is the parking fee at the school. She already paid parking fee at the school, $360. If she decides to go with the train, can she avoid the cost?
No, she can't.
No.
It's already paid.
It's already paid. If she decides to go with the car, can she avoid the cost? No, it's already been paid. So that's a sunk cost. For that reason, we're not gonna take into consideration the cost of the parking fee. So at this point, let's see the sunk cost, the cost of the car is the sunk cost, not relevant. Annual cost of the insurance, not relevant because it's sunk cost. It's gonna remain the same regardless if you drive or take a train. Cost of the gasoline, yes, that's irrelevant. The other cost which is relevant from this, maintenance and repairs. Maintenance repairs, that's a relevant cost because in the long run, we have to maintain the car. Monthly school pass, parking, is not relevant because already been paid. Regardless if she drive or take the train, she already paid for it. Same thing like if you pay for the, let's say for the Compass card, a monthly fee for the Compass card. If you decide to go for vacation for 1 week, nobody from TransLink is gonna call you and say, "Hey, I know you were not in BC. We're gonna give you the refund for 1 week not using the SkyTrain." Right? That's never gonna happen. So for that reason, it's the same cost. So at this point, we have cost of is 50, almost 57 cents per kilometer. Let's see what other costs we have. On top of that we already talked about, we have reduction of the resale value of the car per kilometers driven. Is that relevant cost?
Yes, because you're gonna drive a certain amount of kilometers, right?
Yeah, that's totally correct. The other one, round trip train fare. Is that relevant cost? That will be cost for the alternative, so that will be relevant cost. Next thing, benefits on the relaxing on the train. When you're on the train, you can relax, you can read a book, you can read the cell phone, you can text like crazy, and you can do all many other things. But can we measure it? Because we cannot measure it, we don't know. Cost of the putting the dog in kernel. So now she has a dog, which we're gonna put in this kernel, regardless if she go with the train or she gonna go with the car, because she doesn't want to take the dog with her. Is that cost will be relevant for our decision? Can she avoid that cost? Choosing one alternative versus another alternative.
No, it's a sunk cost.
No, it's a sunk cost. It's a future cost which doesn't change, right? But it's irrelevant. We haven't paid it yet because we haven't made a choice. But since regardless what we choose to do, we have to pay the $40 per day for that dog, regardless if we go with the train or we go with the car. So for that reason, since it doesn't change between alternatives, we eliminate it. Benefits of having the car, definitely benefit. Hassle to parking the car, definitely hassle to park. But can we measure it? No. For that reason, we're gonna disregard those one. And the last thing is the pay cost per parking per day. In the new place that her friend lived, that's $25 per day. Is that relevant for our decision? Definitely relevant, because if we go with the train, we don't have to pay $25 per day. But if we go with the car, we have to pay those $25 per day. So let's keep going with this. So this decline the resale value is of additional miles is a relevant cost. Round trip of the train fare is definitely relevant because that's the cost for the other alternative. If we go with the car, we can avoid that cost. Relaxing on the train, we cannot measure it, so we're not going to take it into consideration. Kernel cost, yes, that's definitely irrelevant because regardless which options we choose, we still have to pay it. Next one is the cost of the parking on the new place. Yes, that's irrelevant because if we go with the train, she doesn't have to pay it. And the benefits having the car and the hassle to park the car, since we cannot measure those two, we cannot measure. So at this point, once we do the calculation, when we choose only the relevant cost, we're going to come up with the following calculation. So it's going to cost her $114.86 to go with a car and $104 to go with the train. So based on the cost, obviously, go with the train. But the question is, if it's you and you have to choose between those two options, which option are you going to choose? Train or a car?
Train all the way.
Train. All the way? I personally, if the difference is only $10, I'm going to go with the car. If the difference is more than, let's say, $80 or $60, then I'm going to go with the train. If the difference is only $10, again, I'm going to go with the car. Why? Because I prefer to have that freedom driving the car rather than be stuck with the train and only get out where the train stops. But that's my personal preference. So now, in order to make a decisions, we have to understand that we can base our decision based on the financial statements, full financial statements, or based on the different approach will be the differential approach. So we're going to see only the differences of what we're improving versus what we're saving. So let's see this company. This company has the following income statement. You see sales, product cost, which is variable. Then you're going to have fixed cost, operating income. Current situation, company generating $80,000. The company decides to invest in new machine, which cost $3,000. But when they invested in that machine, they were able to save $15,000 on labor. So the question is, should they invest in the machine or not? Should they rent the machine or not? Obviously, the answer should be yes, because their income, as we can see, operating income jumped with $12,000. Why? Because even though the machine rental cost is $13,000, they were able to save $15,000. So the savings on cost is more than the rental cost. For that reason, yes, go for it. So now, how can we do the calculation? One calculation is just to look at the cost and benefits, just purely cost and benefits. The other option is to look the entire financial statements. The question is, only in rare situation we're going to have enough information to prepare the entire financial statements with both alternatives. So we might not be able to see this, but what we can see the cost benefits. That's why we're going to choose this differential cost approach in order to make a decision. The other thing is, when we prepare the full statement, we can easily mix relevant and irrelevant cost, especially on the fixed cost. We can easily include common cost versus the traceable cost to the product or to the unit. So One of the most important, let's start making decisions now. Once we know that we have to eliminate the costs which are not different between alternatives, and we can eliminate we can use the differential approach. So let's start working here on the cases. First one will be add to drop a segment. This is one of the most important decisions for the manager, whether to add to drop the business. Now, due to declining popularity of digital watches, this company digital watch line has not reported a profit for several years. Now the company considering discontinuing this product line. How they can make a decision? Decision rule is, as long as savings on the fixed cost is higher than loss of the contribution margin, go for it. If that's not the case, no go. So, how can we interpret this? Well, that will be very simple. We're going to use Excel spreadsheet very quickly, and I'm going to show you on the Excel spreadsheet. Let me do some modification first before I show it to you, so you can have to spend time on this. I share it. Here we go. Now, what we need is one last thing that they have to do is to format the cells. Okay, so we have cells, we have variable cost, and then we have contribution margin, and then we have fixed cost, and then we have operating, right? So what the decision rule says, as long as if the fixed cost is 1,000, but here the contribution margin, I put it in the wrong place, just a second, let me fix this. If the fixed cost is 1,000 and the contribution margin is 800, as long as the fixed cost is more than contribution margin, drop it. Discontinue that division. Why? Because if I stopped, or currently, am I making money or not? I'm losing $200 at this point. Why? Because my contribution margin is not high enough to cover my fixed cost. Make sense? Can you guys see my screen?
Yeah.
Yeah.
Yes.
So what that means is my fixed costs are more than the contribution margin. So if I eliminate this division, for example, I'm going to save $1,000 of not paying fixed cost, but I'm going to lose $800 contribution margin. But hold on a second, my savings is more than the money that I'm losing. I'm saving 1,000 versus losing 800. So I'm going to profit $200. The other scenario would be if my contribution margin $1,200. Well, in that case, it doesn't make sense you to drop the division. Why? Because that division generates contribution margin higher than the fixed cost, covering the fixed cost, and there's something operating income left for you. So as long as the contribution margin loss is more than the fixed cost, no go. Don't drop the division. Okay, let's go back to the.
And sorry, Evan, if it was the same, like it doesn't make any operating income.
What do you mean? If you have 1,000 and 1,000,
Yes.
what are we gonna do? Obviously, we're on the break even here, right?
Okay, yeah.
Do you
But
want to
is it viable to keep it going? I mean, still, if it doesn't make isn't making any extra money,
do you want to keep going? You're the
I don't.
manager.
Okay,
You're the manager. Do you want to keep going?
I don't think so.
Why not? If you think yes, tell me why. And if you think no, what? Tell me why. Is it good for the company to work on the break even?
No, it's not. There are some other.
Why not? I'm not losing money.
There is some other costs like
Sorry?
labor or administration.
Sorry, say that again?
There is some administration or other costs, and also we need money as a.
Yeah, but we already established that that administration cost is after the contribution margin. So my contribution margin is high enough to cover my fixed cost. So should I drop the division or should I not?
It just really depends which stage is division. If it's
So-
something new, then it's good. We still can develop it and start making some more money. But if, let's say, its division's been profitable before and now it's losing money, then we probably need to drop it. So we need more information.
Again, you have the all information you need. The division doesn't lose money, but doesn't make money. Should I drop it? The division is self-sustained, cover all the costs, variable, fixed cost, everything. We're generating contribution margin which is high enough to cover the fixed cost. We're not losing money. Should I drop it or should I keep it? Come on, people, give me some options.
Keep it, see what's happened.
Sorry,
Keep it and see what's happened to the next period
why should I keep it?
because it's
It-
not losing money.
Yeah, but it doesn't make money. Why should I keep it?
Because this might be bringing additional revenues, which is not directly attached to that.
Okay, that's the only reason. Should I keep it? What if it doesn't bring new revenue?
It depends on future trends as well, because there was a time when Apple, the company Apple was actually like in a worse position compared to Nokia, or like,
Yeah,
but
but they're
like
not losing.
time-
But not they're not losing money.
uh, yeah, it depends on other factors as well, like inflation and future occurrences, which I think we're dealing with in this course. Like we
We're
need to
not
think
dealing
about
with this, but we can consider it. Okay, we can consider it. Tell me one reason why should I work on the break even, or maybe more than one.
Depends if
Well,
you're selling internationally and making international money, like the euro is worth
No,
more
no,
than
no.
the
You're
Canadian
on the
dollar.
break even. You're selling international, but you're on the break even.
Okay.
because it's helping you to cover the fixed cost of the other segments, I guess.
Yeah, that will be one reason. Okay. What else? Give me something soft, not related to the cost. Give me one reason which is not related to the cost. Why should I keep this division?
Maybe the company's brand image.
Okay, brand image. That's good. The thing that I'm looking is keep your employee busy. You're not losing money, but you're keeping them busy. Because if you stop using them, they're gonna stop. They're gonna forget how to work. That's another problem. Because people very easily forget.
I have a quick question to add on to that. Like,
Yeah.
like during COVID-19, when like the pandemic began, like a lot of people could not go to work. So long as like, we are making the break even and we have people working for us, the economy is stable basically. So you should continue in that kind of situation. Is that correct, Ivan?
Relatively, yes, but in general, not. Because if you work in a break even, that doesn't give you any economic growth. Correct?
Okay. It
So-
depends.
So there's no growth in the economy. You're not creating wealth for anyone. We just say you just working the self-sustained kind of stage of reality. The other thing that you're forgetting is once the COVID kick in, the government step up and the government give the people incentive in terms of some benefits, which cover some of the losses. So that's another thing that we should have in mind. So we cannot say that working on the break even during the COVID. I mean, most of the company who shut the doors, they wish at that time they were break even, but the thing is they were not. That's why they asked for the government for help, because they clearly cannot go to the break even, right? So, but let's leave that one. The whole idea, my point is to push in the direction you to come up with the idea that it's good to work on the break even because we're gonna keep our employee working, we're gonna keep the employee morale, and we're gonna keep giving them salary, which is good for Canadian government. Why? Because once they pay the employee salary, Canada revenue is gonna take their money in form of taxes. So let's go now with our example here. And our example shows that segment of that digital watches. Remember, they're losing 100. They're in the loss. They're trying to figure out this company reporting losses for several years. We're trying to figure out should they get rid of it or should they keep it. This is the statement that they prepare. Some accountant prepared this statement for us. He said he split the cost. As you can see here, we have a contribution margin statement, sales, variable cost, fixed cost. So sales are 500, variable cost 200,000, contribution margin 300,000, fixed cost 400,000, net operating loss $100,000. Now the question is, how much of those fixed costs we can actually avoid if we decide to close this division? Close investigation reveals that the total fixed general factory overhead, this one, general factory overhead, which is right here, this one, of $60,000, and general administrative expenses for $30,000. Those two will not disappear, will not be affected if we drop this division. Those fixed general factory overhead and general administrative expenses will be reallocated to the other product lines. So those are strictly common costs. So since they're common costs, are they relevant for the calculation of the net operating income for this division? Absolutely not. Common cost should not be traced to the division. Only traceable cost, the cost that you can avoid if you drop the division. The other thing is, this equipment, which we're claiming depreciation of $50,000, has no resale value, and we cannot use it for anything else. So it's worthless. So since we know this information, and since we know the general factory overhead is 60,000, depreciation 50,000, that's 110. And now the general administrative expenses is another 30,000. That's 140,000, which cannot be avoided. Shall we drop this division or not? Because if we eliminate from here 140,000, this division actually become profitable on $40,000. Now let's use that differential approach or contribution margin approach in this case. So what we're going to do, we're going to lose the contribution margin, or the other way. Let me see if I can flip this one in the Excel spreadsheet so we can work together. I believe I should be able to do it. Let me copy this. And let's flip to the Excel spreadsheet and do it then. Just give me a second and I'll show you what I'm having here. Okay, I got something here. Just a second, let a little bit formatting, and I'll be ready to go in just a second. Okay, so share my screen. This is our company, correct? Digital watches, which losing $100,000. Now, after the investigation that we did, we already figured out that this general factory overhead will be transferred somewhere else. So they shouldn't be here at all. The general administrative expenses also will be transferred somewhere else. They shouldn't be here at all. And the last one is depreciation of the special equipment or this equipment that we're producing it, since it has no resale value or we cannot use it for something else. We should eliminate it as well. So is this division actually losing money? What would you say? Can you see my screen?
Yeah, I think it's
Yeah.
not losing money, right?
It's not losing
Yeah,
money,
I agree.
right? So that's one way to look at it. The other thing is, the other approach is, what's the other approach? I'm going to copy this. I'm going to flip it here. So now, if I decide to stop with this division, what I'm going to lose? This one is gone. What else is going to go? Factory overhead is going to stay. Salary of the line manager, gone. Depreciation stays. Advertising direct, that's going to be gone. And the rent of the factory space, it's also gone. So where am I? I'm losing $300,000 here, but I'm saving 140. What would be my income now?
So what about for the sales fund?
Sorry?
For the sales fund? Oh, no, I got it.
Let's go again. If we decide to stop this division, what we're gonna lose? Sales gone. Variable cost gone, variable cost gone, variable cost gone, contribution margin gone. Can you see it?
Yes.
What else is gonna go? Salary of the manager gone. Advertising gone. Rental of the factory space gone. Where we are? Did we save money?
I think we're still losing money.
We're still losing. How much we're losing? $140,000. So where we are? Better with the division or worse with the division?
We should keep the.
We should keep it, right? Because the safe loss is also gain. Make sense? Let's copy it here so you can see it on the same side by side. I believe this should work. Just format it at this. So if you put it side by side, if I eliminate this division, that's where my income will be. Where is my income now? Only 100,000 loss. So should I drop it? Absolutely not. Because I'm gonna lose at least additional $40,000. Okay, let's go back to slides. Let's see what's waiting for us on the slides. So the incremental, the contribution margin approach, we're losing the contribution margin, but we're saving only those one. So basically, if our saving is 260, but we're losing 300,000. For that reason, don't drop it. The other way we could look is drop the entire division, keep the costs that you cannot avoid, eliminate all the avoidable costs, and if we drop it, we're gonna lose $40,000 more. So our income will be, instead of 100,000, it's gonna be net loss is gonna 140,000 loss. Now, so what is our problem? Our problem is allocating of the fixed cost. Common costs should never be allocated to segment reporting, because actually make that segment or product less profitable and looks like losing money. But if we eliminate it, we're not gonna save. In the contrary, we're gonna even lose more. Unfortunately, it's gonna take, if you don't do this calculation in real life, it's gonna take time until you figure that one out. By the time you figure out that by stopping something, you're actually losing more, it might be too late. Usually it takes 3 to 4 months you to figure that one out. Once you figure out, you might have to shut down the company, entire company. Why? Because you make one wrong decision based on the allocation of the common costs which shouldn't be allocated into the segment report. Now, next decision that we have to make is make or buy decision. When the company is involved in more than one activity in the value chain, we can say that the company is vertically integrated. Now, decision to carry one more activity on the value chain or buy externally, that's what it's called make or buy decision. Also, every decision is going to have positive and negative. Which are the positive? Positive are that once we do it, there will be smooth flow of the parts and material. We can control the quality and we can enjoy the profits. But the disadvantage is we losing the opportunity to get it from the supplier that might create economies of scale advantage. So let's see. This company has this following structure. They have direct material. I'm going to copy it again and I'm going to flip it to the Excel spreadsheet just in case. I'm going to wait there until we decide to go to the Excel spreadsheet. Just give me a second. Sorry, it was more than a second. So this is the cost structure. They figure out that when you're producing this product for it costs them $30. Now what's happened here is this company, I'm going to copy this and now we can move directly to the Excel spreadsheet. I already have the information here, as you can see, and I'm posting the other information here as well. So we have everything we need. Just going to make this one bigger and wider so we can have everything on one page and we don't have to worry about it. So this company has the direct material, direct labor, variable overhead, depreciation, special equipment, supervisor salary, general factory overhead. Unit product cost is $30. That's based on our statements. Now let's take a look closely of the entire statement and see what's going on. First, the special equipment, which is used to manufacture this product, has no resale value. So that depreciation of the special equipment is irrelevant. We can just get rid of it because there's nothing we can do with that equipment. Next thing, the total amount of the general factory overhead, which is general factory overhead, which is allocated on the basis of direct labor hours, would not be affected by this decision. So regardless what we decide, if we decide to discontinue our item, this general factory overhead will be assigned to another division. We cannot save on that. So that's irrelevant. Now, this product, the $30 cost, came because we producing our production is 20,000 units. Now the outside company comes and say, hey, you know what? I can sell you those 20,000 units. Now the offer, I can sell you those 20,000 units, but I want you to pay me $25 per unit. So in total, I want you to pay me $500,000. Now, based on my initial report, it will make sense, correct? Because in that case, it's gonna cost us $600,000. So if we buy it from outside, it's gonna cost us only $500,000. That's gonna save us $100,000. But if we look closely and we understand that this general factory overhead and the depreciation of the selling equipment, those costs cannot be avoided, and they still gonna stay with our company regardless if we make this part or not. Then the actual cost for those 20,000 units is actually only $17. So that gives us actual cost of 340. So if we decide to buy it from outside, what's going to happen? This is how much we're going to save. This is how much we have to pay. What's going to happen? We have to pay $160,000 more. Why? Because our cost is only $17, which makes our product $8 cheaper if we make it internally. And because the total units are 20,000, that's why we're losing $160,000. The question is now, should I accept the offer? What would you say? Shall this company accept the offer? Can you guys hear me?
Yes, I don't think that they should accept the offer.
So my suggestion will be, if this company wants to lose $160,000, go for it, accept the offer. If you have $160,000 that you don't want them and have nothing to do with them, you just want to throw it in the garbage, please go for it and accept the offer.
We shouldn't take the offer.
Absolutely not. Of course. But again, if the company wants to lose $160,000, they can go for it. Let's go back to the slides and let's continue with the slides. Do you understand the logic why we should continue with producing our product? So simply because if we make it, it's gonna be cheaper for us. The only cost that we're gonna have is for direct material, direct labor, variable overhead, and supervisor salary. So if we stop making it, we can save only $340,000, but we have to pay $500,000. So we clearly gonna lose $160,000 over the 20,000 units for the decision to buy versus to make it. For that reason, we should keep making it. So shall we make or buy? Definitely make it. Again, the decision lies on the fact that we are allocating common cost, which is general factory overhead, into the cost of the product. And we are allocating depreciation and equipment, which has no resale value for us. The other major category of the cost, which is always relevant for our decision, is the opportunity cost. What is opportunity cost? Opportunity cost is generally benefit forgone as a result of choosing one option versus another. Opportunity cost is not actual cost. You're not going to see the actual dollar amount reduction, but we have to be, it has to be considered. So one of the decisions that you're choosing the opportunity cost is the special order. Special order is something very interesting, which is one-time and one-time offer only, which doesn't impact the company capacity, doesn't impact company normal business of with the other customers. No one of the other customers gonna find out about this special order. Our business is not gonna be affected. So when analyzing the special order, we can only use the incremental costs and benefits. Those are the ones who will be relevant for our decision. Let's see this. This company make a single product, with normal selling price of $20 per unit. Foreign distributors comes and says, can you make me 3,000 units, but I'm gonna pay only $10 per unit. This is one-time order, and that's not gonna affect our business. The other customers not gonna find out that we're having this offer for 50% of our normal selling price. So that's not gonna affect our business. The other thing that we should consider is, do we have the capacity to do it? Our annual capacity is 10,000 units. Currently, we are producing and selling only 5,000 units. So our capacity is not going to be affected. We are within the relevant range. So let's see now. If the company producing this product in the normal course of business, this is what's happened with the company income statement. At this point, producing and selling 5,000 units at $20, company generate $12,000 operating income. The question is, what's going to happen if we produce and sell 3,000 more at $10 per unit? Well, let's see. I'm going to get this one. I'm hoping this is that's Excel spreadsheet. I'm going to get it again, and I'm going to flip it to the Excel spreadsheet that we use it, and let's think about that one on the Excel that we have prepared. Second, I need to do some changes here. Almost ready. Just give me a few more seconds. Just to increase the size a little bit. Have it ready. Okay. So now I can share my screen with you. So this is our current situation. Currently, we are above, definitely above break-even. With 5,000 units, we are above break-even. We have our costs as a total. From here, can we extract the costs per unit? Having in mind that we have this. Can I get my cost per unit? That will be the question. So obviously, I'm going to flip it here and see what's going to happen. Since we're producing and selling 5,000 units, as you know, let's try to find the cost per 1 unit and 1 unit only. We don't need that column, or maybe we can leave it. So, how much is direct material per 1 unit?
$4.
$4. How we get it? We're producing 5,000 units. Remember? We're producing those 5,000 units. So $20,000 is the total cost. The 20,000 divided by 5,000 units is going to give us those notes. Just a second. It's like a crazy with these cells. That will be better. So our cost per unit is 20,000 divided by 5. That's $4 per unit. Direct labor will be 5 divided by
$1.
5. $1. Manufacturing overhead will be
$2.
$2. And the marketing cost will be
$1.
$1. So the total variable cost is $8. Our normal regular contribution margin is per unit is $12, correct? So this company comes and tells us, can you produce me 3,000 units and sell it for me for $10? I have the capacity. That's not my problem. So if I produce 3,000 more units, is that going to change my factory manufacturing overhead fixed cost?
No.
No. Is that going to change my marketing fixed cost?
Also no.
No. So those are irrelevant for my decision. So if I'm selling my 1 unit and 1 unit, they all ask me to sell how many units? They ask me to sell them 3,000 units, correct?
Yeah.
What's going to happen if I sell them only and only 3,000 units? They want me to sell them at how many dollars they want?
$10.
$10. So if I don't sell those at $10, am I going to make a contribution margin?
Yes.
Yes. That will be $2 per unit, correct?
Yes.
How much will be my total operating income in that case? From those 3,000 units only?
6,000.
6,000. So should I accept this special order?
Yes.
Yeah, you
Yes.
should.
Make sense? So what's going to happen? From this special order and special order only, my revenue is going to be equal to 3,000 times 10. I'm going to generate 30,000. My total variable cost will be 3,000 units times $8 will be 24. That's not dollar, that's just a number. So my contribution margin will be equal to $6,000, which contribution margin, since I fixed cost free, is going to flow directly to my operating income. Okay, let's go back to the slides. So, shall we accept the offer? Yes, accept the offer. Why? Because if you accept the offer, again, your revenue is going to increase with $30,000. Your variable cost is going to increase with $24,000, but your contribution margin is going to be $6,000, which contribution margin is going to flow directly to your operating income, since there will be no change in the fixed cost because you are within the relevant range. Let's see this example. Now, this company originally sells lenses for $50. Variable production cost is $10. Fixed production cost is $18. And we have variable selling cost of $1. Customer has requested special order of 10,000 units of the lenses to be imprinted with the customer's logo. This special order will not involve any selling cost, but this company would have to purchase imprinting machine for $50,000. Let's take this one and let's do some calculation before we go to the next slide. Again, I'm going to flip on the Excel spreadsheet. And this time I'm not going to do anything with the Excel spreadsheet. I'm just going to use the normal Excel spreadsheet. And we're going to just flip the question and we're going to do some calculation on our own. So what we know, what we don't know. Let's start with that. What we know and what we don't know. We know that we normally selling this product for $50, correct? We also know that our variable cost is $10. And we have another variable cost, variable selling cost, of $1. First one is variable product cost of $10, and second one is variable selling cost. So the total variable cost is $11, correct?
Yes.
So our contribution margin at this point is per unit
39.
$39. After that, we have fixed cost of $18 per unit. Now this company comes and say, can you sell me 10,000 units? Okay, and this special order will not involve any selling cost, but we have to purchase imprinting machine. So the new machine, it's gonna cost us $10,000. No, sorry, $50,000. But with the $50,000, how many products we gonna do? We're gonna do only 10,000 products, correct?
Yes.
So the question is, how much is the cost per product for this imprinting, for that machine?
It's $5 for the
It's gonna
machine
be
and the
$5. Yes, $50,000 divided by 10,000 units. That will be $5 per unit. Make sense? So let's see what else is on the question. Gonna go to the slides. I'm gonna get the next slide, and I'm gonna bring it here. Now, this company asks you, what is the rock bottom minimum price below which this Norton Optical should not go in this negotiation with the customers? In other words, below what price this company Norton actually will be losing money. Now, there's an ample idle capacity to fulfill the order, and the imprinting machine has no further use after this order. What else we know here? We also know that so the customer requested 10,000 units of the lenses to be imprinted with the customer logo. This special order will not involve any selling cost, but Norton Optical would have to purchase this imprinting machine. And how much will be the cost or the price below which we shouldn't accept this order? So let's think about it. What will be the actual cost for our product?
Is that $29?
So let's see. Is the variable product cost will be part of the cost in our product for those 10,000 units? So we need to produce 10,000 units, correct? What do we need? We need the variable cost, right? With this, we need this variable product cost, which is equal to $10. Are you guys with me?
Yeah.
We're gonna get the $10. Am I gonna have this selling cost? Do I have to consider this variable selling cost? What would you say? When it says the special order would not involve any selling costs, do I have to consider the variable selling cost?
No.
No, that will be zero here. Do I have to consider fixed cost? I have an ample capacity. I have no problem with the capacity. Capacity not my constraint. So I'm with the relevant range. Do I have to consider the fixed cost?
Also no.
Also no. But what's the other cost that I have to consider? Cost for the machine, correct? Which cost for the machine is $5, correct? So how much is the total cost that I have to consider for this order?
$15.
$15. So what will be my minimum selling price that I'm gonna ask this company to pay me in order for me not to lose money?
15.
15. Make sense?
So can you scroll up a little bit so I can get the full picture?
There we go. So let's go to the slides and see how the slides continue. Don't worry, I'm gonna post to this Excel spreadsheet. I'm gonna make it available for you after the lecture. So you're gonna have it for your reference. So this company, again, the variable we went with the cost per unit. They went in the total cost. So if they want to produce those 10,000 units, their variable cost will be $100,000 plus the additional fixed cost 50,000. So the total relevant cost will be $150,000. Divided by 10,000 units, it's going to be $15 per unit. Joint product. That's something interesting. Joint product is some industries, a number of end products are produced from the single raw material. Two or more products produced from the common input are called joint products. And the point where the manufacturing process for each of the joint product can be recognized as a separate product is called split-off point. So the joint costs are up to this point. Now we have a split-off, and now we have oil, gasoline, and chemicals. Now, for the oil, we have a separate processing, and then we have a final sale. For gasoline, we can sell it as it is, or the chemicals, again, separate processing, and then final sale. The question is, which one should we sell? Which one should we produce further, process further? The joint costs are often allocated to the end products on the basis of relative sales value. Although this allocation is needed, we should avoid it for the decision making. Why? Because adding costs which are sunk costs. Joint costs are irrelevant in our decision regarding what to do with the product after the split-off point. It always will be profitable to continue to processing the joint products after the split-off point, after this point, as long as the incremental revenue is higher than incremental cost. Again, after the split-off point, not before. So let's see one example here. We have this picture, right? Let's pretend, let me see if I can get something here. No, I don't want that one. Definitely don't want that one. Let me see if I can copy this and paste it right here. Yeah, I should be able to. All right. So imagine this. I'm trying to make a decision. Should I continue with this or should I not? Gasoline. Let me do a little bit more changes here. Let's pretend that this gasoline, I can sell it as it is at $5 per liter. That's my selling price. The other option that I have is to process it as a oil. But if I process it as a oil, I can sell it for $15 per liter. However, it's going to cost me, let's say, $12 per liter. My revenue will be $15. My variable cost or my cost to process will be $12. Should I continue and process it as oil? So the rule is this. As long as the incremental revenue is more than incremental cost, go for it. So how much will be my incremental revenue in this case? If I can sell it as it is at $5, but if I process it further, I can sell it for 15. How much additional I'm gonna get?
$3 more, correct me if I'm wrong.
So again, at this point, I can sell it as a gasoline for $5. Or I can process it further as a oil, but I'm gonna get $15 more. How much more I'm getting?
Oh, sorry, it's 15.
So how much more I'm getting?
$10 more?
$10 more. But it's gonna cost me $12 to process it and make it oil. Should I go for it?
No.
No. Why? Because I'm gonna lose $2. Make sense? So here my incremental revenue, my actually incremental revenue is gonna be equal to $10 only. Because that's how much more I'm gonna make by my increment, but my incremental cost in this case is $12. So I'm gonna lose $2 right away. So better sell it as a gasoline and make my $5 rather than process it as a oil, make $15 but spend $12 more. Let's go with the next one. Let's pretend that actually, see if I can move it right here. I can do it as a chemical. But as a chemical, if I do it, I'm gonna get extra $20. I can sell it now for $20, but it's gonna cost me, let's say, $10. Should I process? Should I go for it? Go for it. My additional revenue that I'm gonna get will be how much? If I can sell the chemical for 20 versus selling gasoline for 5, I'm gonna get additional $15, right? But it's gonna cost me only $10. So what should I do? Should I process it as a chemical or sell it as a gasoline? Are you guys with me?
Yes.
Yes, process it, or yes, you're with me. Again, as
Sorry.
long as
Can you
the
repeat? Can you
as long
repeat
as
the question one more time?
the additional revenue that you're generating of $15 is more than the additional cost, go for it. As long as the additional revenue is less than additional cost, don't go for it. That's the general rule. So now let's see this example here. We have these two products. We have this company which is cut logs from which unfinished lumber and sawdust are the immediate joint products. Unfinished lumber can be sold as an unfinished lumber or processed further to finished lumber. Sawdust can also be sold as a sawdust or can be processed further to the presto logs. Now, the company says, at this point, the sales value at the split off point is $140 for the lumber and $40 for the sawdust. If I process it further, I can sell it now. The lumber I can sell it for $270 or sawdust for $50. Allocated joint product costs are $176 and $24. But cost to process further for the lumber is $50 and for the sawdust is $20. Which of those should I process further? And which of those should I sell it as it is? That will be the question here. I can easily get this Excel. Let me get Excel and move to the Excel spreadsheet and see what we can do about it. Just give me a second. I have to do some cleaning on the Excel spreadsheet before I show it to you. Okay, already. Okay, this is my Excel spreadsheet. So what we can get from here? This is the information, original information. So at this point, what do we need? We need this information and this information only. Let's get it. So at this point, we can sell it for $140, or we can process it further and sell it for $270. Let's pretend that we're selling it further. Let's just for a second pretend that we're selling it further. If we do that, how much will be our additional sales value for the lumber?
$130.
That will be 130. And how much will be the additional value for the sawdust? $10, right?
Yeah.
But it's gonna cost us to process it further. For the sawdust, it's gonna cost us additional $50. For the sawdust, it's gonna cost us $20. Do I have to consider allocated joint product cost for my decision? No, I don't have
No.
to. Why? Because only it's irrelevant. The joint cost is irrelevant. the fact that somebody allocated, it doesn't matter to me. What I'm gonna chase? Only the cost after the split off point. So for that reason, which product is gonna generate positive contribution margin for me? Now, first product. How much I can generate? I can generate $80, correct?
Yes.
How about the second product?
Lose $10.
It's gonna lose $10. So what that means? That means that the lumber, what should I do? Should I sell it as a lumber or should I process it further as a, should I sell it as an unfinished or process it further and sell it as a finished lumber? What you gonna say? What will be your
Leave it,
advice?
leave it as some finished lumber, right?
Go with the finished lumber, yes. Process it further. Why? Because you're gonna get extra $80. Make sense?
Yes.
How about the sawdust? Should I sell it as it is, or should I process it for the Presto lock?
As it is.
As it is. Why? Because as it is, I'm gonna make $40. If I process it as a Presto lock, I'm gonna lose $10. Excellent. So let's go back to slides. And again, they're gonna do that incremental revenue or additional sales value that every product creates versus the cost to process further and the profit from the further processing for the lumber will be 80 and the sawdust will be 10. So what will be the normal decision? The normal decision is for the lumber, process it further, get the extra $80 for the sawdust, sell it as it is, don't process it to press to lock. Now we're going to the interesting point, which is what we're going to do when we have a limited resources. We always will be in the situation with when we have a limited resources. The question is how we going to make a profitable decisions based on the fact that we have a limited resources. When the limited resources of some type of restricts the company ability to satisfy demand, we're talking that the company has a constraint. Whatever create that constraint is called bottleneck. So every time when we have the constraint, we're saying that's our bottleneck. When the constraint exists or bottleneck exists, a company should select a product mix that's maximize the total contribution margin earned, since the fixed cost, usually those are fixed cost, they not changing. The other thing is, we shouldn't be focusing on the product that's creating the highest contribution margin. Rather than we should focusing on the product that creates the high contribution margin within the constraint. How this gonna look like in reality? Let's get this information here. Let me go to the Excel spreadsheet again. Copy this Excel spreadsheet and move it to our Excel so we can work with this. Give me a second. I'll be sharing my screen in a second. Okay, I'm ready. So I'm gonna stop this one and I'm gonna move to the Excel spreadsheet and let's see what we can get from here. So we have two products. We know the selling price for one unit and we selling price for the other unit. We have the variable expense for one unit and we have the variable expense for the other unit. What else we know? We know the contribution margin per unit. Also, we know the contribution margin ratio. That's our contribution margin ratio here. What else we know? We know our current demand. And we know that processing time that's required for product one is 1 minute. For one unit is 1 minute. And for one unit for product two is 0.5 minutes, half minute. Now the machine one is the constraint resource and is being used for on the 100%. There is excess capacity in all other machines. Now machine one, A1, has the capacity of 2,400 minutes per week. Now, knowing this, the question will be, how many minutes we need to satisfy our demand? If we know that demand is 2,000 for product one, 2,200 from product two, and takes us 1 minute to produce product one, and half a minute to produce product two. Can we calculate how many minutes it's going to take us in total to satisfy our demand? How many minutes I need to satisfy the entire demand for product one? 2,000 minutes. That's very easy to calculate, correct? How many minutes I need to satisfy the entire demand for product two?
1100.
1,100. And that also minutes. So in total, I need how many minutes?
3,100?
3,100 minutes. That's not dollar amount, that's a number here. Right? How many minutes machine one can give me? 2,400 minutes. Do I have enough minutes to satisfy my demand?
No,
No. How many minutes I'm short?
7.
I'm short 700 minutes. Make sense? So now the question is, what should I do? If I know this, what should I do? On which product should I focus first? On which product should I focus after in order to generate the maximum available profit that those two products can give me?
We should focus on product 1.
So as we can see here, product one give us a high contribution margin, correct? And the general rule says, yes, focus on the product with the highest contribution margin. But within the constraint. What's our constraint? On what we are short on? We are short on minutes, correct?
Yes.
So now the question is, if we're short on minutes, what do we have to calculate? Which contribution margin we should calculate? Contribution margin per minute, correct? And that's going to give us idea on which product we should focus. So again, before we do that, how many products we can produce in 1 minute?
One and two.
One product from product one, and how many products we can produce from product two?
Two.
Two products. Is that obvious for everybody?
Yes.
So in that case, how much will be contribution margin per minute for product one?
24.
$24. And how much will be contribution margin per minute from product two?
$30.
$30. So now on which product we should focus first now?
On the second one, right?
On the second one. So what will be our winning strategy here? Our winning strategy will be the following. First, let me get this one here. Let's see if this is gonna work. Yes. First, what I'm gonna do is I'm gonna check. Let me clear this one very quickly. How many minutes available I have? Per week in this case.
2400.
I have 2,400 available minutes, right? It says here. Make sense? I wish I have more, but I don't. So I have only 2,400. So since I know the product two is my most profitable product, first I'm gonna focus on the demand. Which demand is how many units? 2,200 units, correct?
Isn't it 2000 for the product one?
So current demand. Current demand of the product. Sorry, no, product two. Product two, why product one? Product two. We're gonna focus on the product two because the product two is with the highest contribution margin per minute, right? Within the constraint. We focus first on product two. We're gonna satisfy the entire demand, 2,000 units. In order to get 2,000 units to produce 2,000 units, how many minutes I need?
1100.
So I need 1,100 minutes. Since I use 1,100 minutes, after producing the product one demand, product two demand, how many minutes I have available?
1300.
900.
available minutes here. $1,300 correct? Now the question is, obviously now I have to focus on the product one. How many units I can produce with 1,300 left? How many units of product one I can produce? If takes me 1 minute to produce one product. That will be 1,300, correct? So if I produce 1,300, so I'm gonna use all my available minutes, correct? And my available minutes will be 0 because I use everything. Make sense? So what will be my winning strategy? My winning strategy will be produce entire demand for product two, and with the rest of the capacity left for the machine A1, produce 1,300 units from product one. And only in that case, you can generate the maximum available profit. In any other different combination, you're not gonna get anything close to the maximum. Let's go back to the slides. So now the question is, first the question, how many units of each product can be processed through the machine in 1 minute? We already figured out that one. The answer will be,
A.
no. How many units we can process per minute?
Oh, B.
B, 1 and 2. Then which product generate high contribution margin within the constraint, which is minute?
Product 2.
Product 2, yes. Product 2 generates $30, while the product 1 generating only $24. And that's the calculation, how we gonna calculate that one. So for that reason, how are we gonna use our minutes? First, we're gonna satisfy the entire demand for product 2. We're gonna produce those 2,200 units, for which we're gonna take 1,100 minutes. Then with the rest of 1,300 minutes, we're gonna focus on product 1. Once we do this, we're gonna have the highest possible contribution margin. With any other combination, we cannot achieve that highest value. Now the question will be, the logical question will be, well, in that case, why do we need to produce product 1? Why just cannot focus on product 2? And your answer will be?
Because of the demand.
Because of the demand. I don't have demand for more. The argument might be, but product 2 is more profitable. why we just not keep producing? Well, the question will be, what do you want? Do you want sales or you want inventory? Obviously, you want sales. So get your sales. Forget about inventory. Don't build up inventory, even though it's a profitable. Now let's see this question here. For this question, I'm not sure if, oh, it might be able to convert me to Excel. Yeah, I have it in Excel. Perfect. Let's do this question together again. Give me a second again to set up the Excel spreadsheet so we can start working this. Okay, I have it, and let's go to the Excel spreadsheet. So here, what we have? We have these two products. This company makes reproduction colonial furniture from selected hardwoods. The company supplier, those are they're making chair and they're making tables. Selling price per unit is $80 for the chair and tables $400. Variable cost per unit is that much. Now a contribution margin per unit for the first product will be $50, and for the second product will be $200. At this point, we can clearly see that tables is more profitable than the chairs. Now, the company supplier of the hardwood will be able to supply 2,000 board feet per month. The question is this enough hardwood to satisfy the demand? So somebody is going to give us only 2,000 hardwoods, and that's it, nothing more. Again, the question is that enough for me? And if it's not enough, how much is there enough? So, this is my demand. And I have my board feet per unit. How many board feet I need to satisfy my demand? That will be question, correct? So how many board feet I need to satisfy the demand for the chairs, for example?
1,200.
1,200. That's very easy to get it and to calculate, correct? There's nothing scary here. For the tables, I'm gonna need 1,000 board feet. In total, I'm gonna need 2,200 board feet. So, do I have enough hardwood to satisfy my demand?
No.
No. So, what is my constraint then?
The supply, right?
Supply of what? The hardwood, right? Board feet. Board feet is my my constraint, correct? So for that reason, what do I need to calculate? I need to get my calculation margin per board feet. If the board feet is my constraint, I need to get that demand, that calculation. Do I need I already know how many board feet I need for 1 unit. The question is, how much is my contribution margin per board feet for the chairs?
$25.
That will be $25. How about the tables?
Just 20.
Just $20. So which one is my profitable? Which is my winner? My winner is the chairs, right? So what should I do first? I should focus on the chairs first, and after that, move to
The
the
tables.
tables, correct? So let's do the calculation. Let's see how many of the chairs we need. So first, we're gonna satisfy the entire demand. No, let's start with available. How much we have available? Board feet. We have available 2,000, correct? That's it. That's our availability, 2,000 board feet. For my entire demand, first I'm gonna satisfy the demand of the chairs, which is 600. And for those 600, I'm gonna need 1,200 board feet, correct? After satisfy my demand for the chairs, then I'm gonna have available board feet left of 800. How many tables I can produce with 800 board feet?
80.
Tables, I'm gonna produce only 80 tables. Why? Because it takes me 10 board feet. Here I have only 2 board feet. With the 10 board feet, then I'm gonna use my entire demand and available left. In this case will be 0. So what will be my winning strategy here? 600 chairs and 80 tables. Sorry. Yeah, 600 chairs and 80 tables. That will be my winning strategy, correct?
Yes.
Let's go back to the slides and finish the slides now. So the first question was, do we have enough hardware to satisfy our demand? The answer was no, we don't. We need 2,200. The supplier gave us only 2,000, so we shot for 200 board feet. Now, what will be the plan that will maximize our profit? We already established our plan will be
The
B.
B, 600 chairs and 80 tables.
80 tables. Why? Because again, we're chasing the contribution margin within the constraint, which constraint is the board feet. And then we're producing first the item with the product with the highest contribution margin within the constraint. And if there's something left, we go to the next one, next product. Now the question is, if the supplier of the hardwood, we only supply 2,000 board feet per month. Now assume that the company follows the plan that we proposed. Up to how much should this company be willing to pay above the usual price to obtain more hardwood? In other words, what would be the maximum price that this company is going to pay for additional hardwood to produce their tables? What do you think?
$20.
$20 will be the correct answer. Why? Because they won't be willing to pay more than the contribution margin than generated per hardwood, per table. Anything above, they start losing money. Great job. So yes, 20 tables, it will be $20 per board feet. That will be the maximum because that will be that additional contribution margin. Now, what we're going to do as a managers to manage the constraints, we can improve the process. We can add overtime on another shift when it's needed, hire new workers, subcontract product, reduce the amount of defective units produced, or transfer worker from the non-bottleneck divisions. What we're going to do if we have a multiple constraints? Well, if we have a multiple constraints, we can use that linear programming, which is not part of this course. I'm not going to teach you for that one. And that concludes our chapter today.